Most Canadians think the Bank of Canada almost entirely controls mortgage rates, but that's actually not true at all, especially when it comes to fixed rates. And this is why mortgage rates can sometimes rise before the Bank of Canada changes anything at all. Here's the part that most people don't realize. Canadian fixed mortgage rates are heavily influenced by bond markets, and those bond markets are closely connected with what's happening in the United States economy. For example, the most recent US inflation report showed that prices soared by 3.8% year over year. And that's mostly due to gas prices. And when that happens, bond yields can rise pretty quickly. And this matters because when bond yields rise, Canadian lenders can increase fixed mortgage rates, even if the Bank of Canada does absolutely nothing. And that's why you'll sometimes see lenders raise fixed rates when there's no announcement whatsoever from the Bank of Canada. And the market is constantly trying to predict where inflation and interest rates are going to go next. And right now, inflation is still a major concern. This matters because a lot of people still assume rates will naturally come down over time, but inflation can change that expectation pretty quickly. So if inflation stays high, lenders might keep their rates higher for longer than people expect. And in a market like Winnipeg, where affordability is still much better than other places in Canada, demand can continue to hold even with higher rates. So the real takeaway is that if mortgage rates are influenced by a lot more than just the Bank of Canada announcement, we need to pay attention to some of the other big details. And understanding that can help buyers make smarter decisions instead of just waiting for big headlines to show up. So let me know where you think mortgage rates are headed next.